All right, welcome everyone. We're going to be talking about um, technical indicators. Technical indicators. So when it comes to indicators, first and foremost, what you want to think about is what do you want to achieve in the market? What is the goal of a trader? What are you, as a trader who is on your seat? You want to take a trade, right? What are you trying to achieve? What are you trying to get your get a hang of first, right? And what you want to do is that couple of things. Number one, you want to be able to identify the trend. Many times when traders come on the trading platform, especially when they are new traders, they only think of entering trades. Give me a trade to enter. I need to buy. I need to sell, right? Yeah, of course, we know that buying and selling is where you make money from, right? The profits from trading comes from buying or selling. But then the what approach will help you get there? What thinking, what process will help you get there is very important. It's even more important than the entry on the trades. And when in the course of understanding how to use technical indicators, it's important to understand first the mindset where you are, what you're trying to achieve before you know if technical indicators will be of help to you or not, or even how to use them, right? Okay. Now, the first thing you want to do, like I said, is you want to identify the trend of the market. It is always important to remember that the trend is your friend. The trend is your friend, meaning that if you identify a trend and you trade with that trend, the chances of you being wrong in the market will be very, very minimal, will be significantly reduced. Okay? So when you don't identify a trend and you come into the market and you're trying to make a buy trade or a sell trade, that is where your mistake starts. There are times where you enter a trade for a buy, it loses, you enter a trade for a sell, it loses, you enter a buy again, you enter a buy again, sell again, and it loses. The main thing here is that you are completely oblivious of what's going on in the market. You have no idea direction of the market, what the direction of the market is. And once you don't have an idea where the direction of the market is, you will have very low confidence, which will make it impossible for you to even hold your trades to clear out, right? Hold your trade to target, right? And even when you hold your trades to target, you by the time you see a couple of losing trades, you're not going to be very confident anymore. Okay. So what you're trying to do, first of all, is find the trend of the market, direction of the market. Then you find the entries of the market. Now I've identified where the pulse is going. The pulse in this case is the direction of the market. I've identified where the direction of the market is, where the pulse is going. Now you're looking for an area to enter, an entry to enter inside this bus, enter this trade. Now, when you get into that trade at that time, your confidence level is high. You're able to manage your risk properly. At least you have a level of confidence that the market is going to do what you expect it to do. Okay. Now, for you to be able to identify your trend and also find entries, there are a range of tools that you can use. Okay. Now, we say these are technical indicators. The market is not just a technical environment. The market also has a lot of external factors that drive it. We call that fundamental, right? Or news-based events that drive the market. So we are not talking about that now. What we are looking at is how the market behaves on a normal day, in a normal environment. How does the market behave? This is what we call technical analysis or technical moves. These are what we call technical moves that happen in the market, right? Now, when you're looking at using technical indicators, what you want to use technical indicators for are what I mentioned earlier. What are those things? Number one, you want to use indicators to find entries. You want to use indicators, first of all, to determine trend. That's where you're starting from. I want to find what can help me identify trend. And when it comes to identifying the trend, there are a range of tools people use, but here today we're focusing on indicators. Even in with indicators, there are so many different indicators that can be used for identifying trends. All right. Now we're not going to be able to touch every single one of them, but we'll touch some of them that are the more popular ones that are better for identifying trends than others. Okay. So, and one thing you have to understand is this. Once you open your chart, to trade, right? Um, what you are seeing is what your other trader is seeing. What you that's trading in Nigeria is seeing, what the guy in South Africa is seeing, is what the guy in Kenya is seeing, is what the guy in the UK or the US. That's what they are all seeing. Okay. Now, if you all of you are using the same indicators or using whatever it is you're using, there are certain things in the market that all of you will see. There are certain things that will tell you that the market is about to buy, and everybody will see that same thing. There are certain things the market that would appear in the markets on the charts that will give you an idea that the market is about to sell, and everybody will see the same thing. Okay? But what you are looking at here is that when you must understand how indicators or how the market works. The market works by sentiment, mostly by sentiment, right? The market many times is a self-fulfilling prophecy. So if a lot of us are expecting price to buy, what actions would we take? We take buy trades. Now, if there's more buy volume than sell volume, price is going to buy. If there's more sell volume than buy volume, price is going to sell. The market is always luring us into these things. But the thing is, how do we filter? How are we able to clearly see where the market is going and how to enter it? That's where indicators come in, right? So let's get started. And technical indicators are mathematical calculations based on price, volume, or open interest of a security or currency pair. So there's a certain thing, there's something you'll notice about the market. There's a mathematical efficiency that happens in the market. You wonder sometimes, is this market being controlled by something? You will see price come to certain levels that you will expect it to come to. It will act as if the geometry works right. You will see how price will touch. You could go to a chart, right? And then you draw a rectangle on a chart, and price can touch the entire areas of that rectangle perfectly, right? Price will touch the entire range of that rectangle perfectly. So sometimes it looks as though, oh, what is going, somebody controlling price. That's why we talk about mathematical calculations. When you talk about the particular tool called Fibonacci, something that we'll talk about much later, Fibonacci has certain numbers. When you take that tool and you plot it on the chart, many times you'll see how price will respect those levels. You see how price will respect those levels, and you start to wonder, did anybody tell price to respect this level? Right? So, and there's a lot of efficiency in the market, right? So, um, technical indicators help traders analyze market trends, momentum, volatility, and potential entry and exit. So indicators are important. Okay. And in this case, we're talking specifically about technical indicators. Indicators don't predict the future perfectly. It gives signs that will help the trader interpret what the market might be about to do next, right? So there are different types of indicators. First, we have the trend indicators. We have we have trend indicators. For trend indicators, mostly, like I said, we're going to be focusing mostly on the important. We'll go to the chart after this, and then we'll be able to use these indicators. I'll be able to show you guys how you use these indicators. Okay? So for trend indicators, these are indicators that help you determine the trend of the market, trend of the market. And that's what I said before. And see, we're starting with trend indicators because that's the first thing you want to do in the market. Find trend of the market. find the trend of the market, all right? So you have moving averages, and then you have MACD. MACD is moving average convergence divergence. Moving average convergence divergence. But moving average is more popular than the MACD. But the MACD is also quite popular. But I will tell you that if you're looking at which one of these is more popular, with average is more popular. Yeah? Then, um, then you have momentum indicators. Now, these momentum indicators show the strength of price movement. Now, when price is displacing very heavily to the upside, it tells you that price is buying. And then what you should be doing mostly is looking for buy opportunities because price is making huge the momentum of price is towards the upside. If the momentum of price is towards the upside and you go and be looking for sell trades, you might find that you start losing trades, right? Why? Because market is buying. Momentum indicators telling you that price is going upwards, and here you are entering sell trades, and that's not a good one, right? So for momentum indicators, you have ROSI, or that the relative strength index, and the stochastic. These are also very popular momentum indicators. Very popular. So they show you where the direction of the market is at the moment, right? What the momentum, not the direction, what the momentum of the market is. They show you when the market fades. When that momentum fades and market is about to reverse, they will show you as well. Right? And they do this whether the market is on the buy, is towards the buy side or the sell side. Now, most of the time, traders that use these two indicators, relative strength index and stochastic, they tend to use them together because they behave very similarly, and then they could help confirm each other's signals. It can help confirm each other's signals. So you might see that ROSI is saying buy and stochastic is also saying buy at the same time. So it's like an extra layer of confirmation because one thing we're looking for in the market as well is we want to have a certain level of certainty. In the market, there is certainty is one word that is very scarce because the market plays by probability. Market plays out by probabilities. So a lot of time you are not looking for certainty when you take a trade. You take a trade based on okay, I know the numbers. Maybe it's a strategy you are using to approach the market. You know that in if you take 10 trades, 7 of them are going to be profitable. You don't know the exact ones that will be profitable, but out of 10, 7 should be profitable based on historical data of that strategy. So what we are looking for is that those trades we are taking, we want to find a way to fine tune them in such a way that we raise the level of expectancy. We raise the level of expectancy on each trade. That's what we're trying to do. We're trying to raise the level of positive expectancy on each trade. So I can look at a trade and I can say, okay, this trade, based on certain confirmations, I will call this trade an A plus trade or an A trade, which means that my confidence that this trade is going to play out is higher than my confidence in another trade or in another trade setup. So how do we do that? We do it by looking for confirmations. So by the time we have 1, 2, 3 signals telling us that the market is about to buy, that the confidence in that trade increases. The confidence in positive expectancy increases. So we say, okay, I'm expecting this trade to play out based on this, lining up to tell me that this trade is going to go my way. Now, there is no guarantee that it's going to go your way, but it's like stacking the odds in your favor, right? Stacking the odds in the favor of that trade so that you can have a high level of confidence in the fact that that trade is likely to play out. So that's what happens many times when traders use multiple to try and confirm where the market is about to go, basically what the market is about to do at the moment. Okay? So many times, those traders who use ROSI tend to use stochastic together with ROSI. We're going to look at it shortly, just to make sure that they are confirming price properly. Right? Now we have volume volatility indicators. These show price moves in a given time. So we have Bollinger Bands, we have ATRO, the average true range. So these bands, they show us volatility. Now, volatility, when you hear the word volatility in regular life, in regular business, volatility indicates instability. Also connote instability. But in the market, volatility is what is how traders make money. If there's no volatility, the market doesn't move. The lack of volatility is like when you're doing when you're doing a regular business where you buy and sell, you buy something for a particular price, let's say $10, and then by the time you bring the commodity to where you want to sell it, you realize that the price is the same, which means that you can't sell it for a higher price than you bought it. Now, if you buy something for $10 and you're going to sell the same thing for $10, you are not only unable to make profit, you're actually running at a loss because it costs you, there's a cost of even buy, buying, carrying that thing and everything and bring it to where it is. So that is what a lack of volatility is like in the market. If you buy and price doesn't displace to the upside or downside, doesn't move, you can't make money from that. And that's why volatility is very important in trading, very important to us as traders. We want to see volatility. And traders like to trade instruments that are very volatile. That's one reason why gold is highly traded or heavily traded by many traders. A lot of traders like to trade gold because it's very volatile. Also, BTC, very volatile. You can enter a trade now, you see price just move heavily. Price can move very quickly. Now, what will take currency 2 days, the moves that will take a currency 2 days to happen, you can see it happen in an hour on gold. So because of that, gold is arguably the most heavily traded instrument in the entire world, right? Actually for speculative reasons. For speculative reasons, by the time you're um, when looking at general usage, you go to currencies. But when it comes to buying and selling to make profit online, gold is the number one most heavily traded instrument. And the reason for that is because it's very volatile. Okay? So we have Bollinger Bands and we have ATRO, the average range. So these indicators will show you the volatility of the market at the moment. Sometimes the volatility is very high. You can see the market running wild, and usually that happens during during market sessions where there's a huge amount of players, like during the London session, during the overlap between the London and the New York session, right? But by the time you go to the Asian session, the Asian range, you see that the volatility can be very low in certain instruments, especially currencies. You see the volatility very low. But then when London session opens, you see volatility expands again, and you're seeing a huge amount of expansion in volatility. Then price starts to move very heavily, right? So this indicator is one of those indicators that helps us see the level of volatility per time. Then we have volume indicators. Volume indicator tends to confirm trends by analyzing trade activity. So we have the volume moving average, we have the unbalanced volume, OBV, and then we have the VMA. These are indicators that help us. Now remember, we're just showing you all of these indicators, all of these indicator categories. When you want to trade, you're actually not using all these indicators at the same time. So when we go to practical session, you will see what I'm saying. All of these are, you can pick one, two, three, like that, and have a combination. Some of them will tell you what the current trend is, right? Then some will, tell you what the momentum is. Okay? So usually trend and momentum are and a couple of other things are what you will need. You won't need every single thing. For example, the volume indicator is a nice thing that you could, you know, use and check sometimes, but it doesn't really matter what volume it is, what the volume is in the market. But there are indicators that can help you. Just in case you want to see what the volume is in the market, these indicators can help. But there are some things that are not relevant when it comes to your trading. So you will not be using all these indicators. That's what I'm saying. You will use actually part of them. But it's important that you know that these indicators are available, as even if you're not going to use every single thing. Okay? So popular indicators. We have the moving averages. And for moving average, there are different types of moving average. We have the SMA. SMA is the simple moving average. We have the EMA. EMA is the exponential moving average. Okay? So most of the time, the SMAs are the most popular ones. And there's something about popular in the market. When we say popular, it means that a lot of traders tend to gravitate towards that. And when a lot of traders gravitate towards that, it's helpful too because when you and I are looking at the same thing and there's another 1 million of us around the world looking at the same thing, we are likely to be taking the same action. And these actions there's a chance that it will be profitable, it will go our way um, most times. Not all the time, but most time. There are times what we call smart money will use all of this information against the retail traders and make more money off the retail traders. Most of the time, as a retail trader, you can expect to be profitable. Because when it comes to profitable, remember, all of this is within what we call strategy. There are different areas of trading. Number one, there's risk management. Number two, there is the psychology of trading. Psychology has to do with what is your mental state when it comes to trading, right? Are you feeling angry? Are you feeling revenge? Are you feeling, how are you feeling exactly? So how you are feeling, it's going to affect the way you trade and what actions you take in the market. As a trader I knew of, this guy would trade and why I'm saying this, I'm just mentioning this in passing. What I want to actually tell you is that what we are talking about here is within what we call strategy. So you have risk management, you have psychology, then you have strategy. So strategy is one of the things that it takes to be profitable in the market. Okay. So I was mentioning something about psychology. I said there's a trader I knew of. This guy would trade, do the same thing. He will fund his account, he would trade a certain way, and then he will lose money, he will blow his account. And then this guy will rapidly fund his account again and repeat the exact same thing he just did. And then he'll blow the account again. Then he will fund his account and repeat the exact thing he just did. And he could do this back to back 10, 20 times. Okay? So the question you want to ask yourself is this guy actually trading to make money? This is the part of psychology. I'm just mentioning this, right? We have a session where we'll talk about this. But the question is he actually trading to make money? I will tell you that what I think is that he is not even conscious of the actions he's taking. He's not conscious of the actions he's taking. That's why you know, I guess we're going to talk about that deeper. But what I'm trying to say is that there are three areas here that you need to, get very right for you to be very profitable. So this area we're talking about right now that has to do with indicators is the area of trading strategy. Yeah. So the popular indicator, like I said, popular indicators are good because they can help a lot of traders decide where the market is going. Once we this was a lot of us think that market is going to buy, chances that the market is going to buy is very high because the market tends to behave like a self-fulfilling prophecy. Okay? Why? Because if all of us expect that there will be traffic and we are all running towards a particular exit, what will happen? There will be traffic. So we are basically creating the traffic. That is to an extent, that's the way the market works as well. So when you want to use indicators, use the ones that are quite popular, not the ones that are not popular. This is not a market where you want to be alone. Oh, let me do my own thing. No, because you don't have the capacity to move the market. Since you don't have, you personally as a retail trader, you don't have the capacity to move market, you don't try to be a lone wolf. If you're a lone wolf, you get eaten up in the market. Serious, period. If you are a lone wolf in the market, you will get eaten up alive. So you want to be able to see what other traders are seeing, do what other traders are doing. If you're not able to see it part time, you use tools that can help you see it, or you keep training your mind in such a way that you can see what the market is doing. So you can take advantage of it the right way, right? So moving averages are used to identify trends. So when price is above an SMA, remember it's a simple moving average. When price is above an SMA, it means that price is in an uptrend. We'll see this shortly. So when price is below an SMA, it means that price is in a downtrend. So you just plot an SMA on your chart. When you see price above it, it tells you price is going higher, higher and higher. And when price is going an uptrend, what you do is you look for buy trades. When you can see clearly that price is moving higher, which means price is in an uptrend or getting into an uptrend, what you do is you look for buy trades. When you see price dipping, price is coming downwards, you look for sell trades because price is coming downwards at that time and price is trending downwards. So if price is trending downwards, you start to look for sell opportunities. That's what this is telling you. So when you use tools like this, indicators like this, they give you an idea of what price is going to do next, so you know exactly what to do. Now imagine that this really helps you, and you don't have this on the chart. You won't know when price is about to turn bullish or bearish. You won't know where price is going to turn bullish. You won't know when price is about to turn bullish or bearish, right? Then we have RSI. RSI usually has a scale, right? A scale to it, 0 to 100. For There's what we call overbought and oversold. So the idea behind overbought and oversold is this. When price buys for a period of time and he keeps buying, at a point, he loses buying momentum. That's why we say ROSI is a momentum indicator. So when price buys and buys to a certain level, it loses that buy momentum and it tends to begin to sell. And it works in the financial market across several markets, across several instruments. For example, when you make a buy, when you buy stocks or you buy any investment and the price rapidly appreciates, what you want to do, as a smart investor, what you want to do, a smart investor, basically as an investor, what you want to do when price goes very high, you sell off some. It's called profit taking. You sell a part of that investment and bank the profits, right? And then you keep the rest of the investments running. So you would see that when price goes up very high, it tends to pull back. Why does it pull back? It pulls back because of profit taking. It pulls back, and what does profit taking do? Profit taking introduces sell volume into the market. So which means that everybody was buying, but now some people start to sell. And when that happens, puts pressure on price to come down a bit. But because price is in an uptrend, that sell-off that pushes price down can be buying opportunity for those who missed out on the first wave. So that's what this is about. Overbought means that price has bought to a certain level. It can't continue just buying indefinitely. So it sells off. Why? Because some people begin to, close up their buy trade because they are in profit. Start to close out their buy trades. So price depresses, comes down a bit. And at that point where price is about to come down, that's where you also want to be making your sell trade. That is what we call overbought level. So an overbought level is an area where price has bought to a certain level and it begins to sell. Now, for an oversold level, it's the same thing. Price can't continue selling indefinitely. Price can't continue selling indefinitely. So since price can't continue selling indefinitely, it will sell to a point, it comes to what traders call discount level. So that discount level becomes a very attractive place to start buying again. So you see that price will sell to a certain level and then from there it picks up again and starts buying. Why? Because in the minds of traders and investors, it has gotten to a discount level. So it becomes attractive to buy again. Now imagine you are doing any business. You are in the business of buying and selling that particular product or so, and then suddenly they call you and tell you that the price of this thing has rapidly drops because of certain events. Product itself is very good, but the price has rapidly dropped because of certain events. What do? You go and stack up on it. Even if you were not ready to buy at that time, the price is so low. What do? You buy. You buy and stack up on it, and then wait till price begins to rise again, and then you make your profit. So that's the idea behind overbought and oversold. Price doesn't continue going higher forever. Price also doesn't continue to sell forever, right? So we'll see that. And there's a scale, an ROSI scale. Stochastic is also like that, right? So you see that there's a scale from 0 to 100. When price is moving towards 100, that's an overbought area. So we're expecting price to sell from an overbought area. When price moves towards 0, closer to 0, that's an oversold level. And then from there, we should expect that price will begin. Right, that's the idea behind overbought and oversold. Like I said, ROSI and stochastics have this feature. That's one reason why traders tend to use them together. They have Bollinger Bands. Usually they expand during areas or during periods of volatility. I'll show us these things on the chart shortly. Usually, Bollinger Bands expand during high volatility and contract during low volatility. So you'll be able to see that the market is moving rapidly right now by using Bollinger Bands. Bollinger Bands will show you that price is moving rapidly right now, or price the volume in the market right now is very, very little. So you see the bands become very constricted. Right? How do you use indicators? So before we talk about how you use indicators, let us go to the chart right now and find some indicators. Okay? So this is an MT5 chart. This is an MT5 chart. I'm sure we can see my screen. If you can't see my screen, let me turn this to green and red so that we'll see them clearly. Okay. So this is our chart now. This is our chart, right? Now, what we're going to do, we're going to work with three indicators we just talked about. Is it 3 or 4 indicators? We'll look at the moving average. Moving average is for trend. Then we'll look at the ROSI and stochastic. Both of them are the same. They behave the same way, so we might check out both of them, or we'll just use one. Then we have the Bollinger Bands that show us the volatility in the market. So let's start with the moving average. So what we do is we'll come to the chart here, insert, sorry. When you come to insert, we look for indicators. We come to trend. So you see there are different types of indicators here. We look at trends. For trend, we come to moving average right here, moving average. So this moving average is asking us what are the settings. You see, method simple. When you click there, you see that there's exponential, there's smooth, there's linear, weighted. So we will stick to the simple moving average, and then we will stick on apply close. And this 50 is telling you the kind of moving average it is. So this 50 basically measures, you see this, we call these candlesticks. This 50 measures 50 candlesticks per time, and it plots a moving average line according to that. Okay. So if you have this is what we call period 50 moving average. You have a period 100 moving average. You have a period 200 moving average. You have a period 10. Period 4, period 7, period 14 is different. The only thing is that if the period is so wide, is so much like 50 or 100 or 200, the moving average becomes very slow, which means that most of the time, by the time it shows you the trend of the market, the trend has already gone. The trend has already passed. Okay. By the time it starts to give you an indication of a trend change, the trend has already passed. You've already missed it. Okay. So that's the only thing about having a long period. But a shorter period too, is going to be telling you that the trend is will be showing you that the trend is changing very frequently, which can also be deceptive. So a number in the middle is more preferable. 50 is actually a good number, right? Then, of course, there are times where we have a strategy that involves us having a moving average crossover and all that. That's when we're looking at entries. So this is what we mean by a period. So the period can be very high. In that case, the moving average is very slow. It will show you trend when the trend has already passed. Okay, but if it's also very tight, you put it on like 5 or 4, it will show you it will be showing you trend change very quickly, which can be very deceptive. Now the trend may not be changing that quickly, but the moving average will start showing you that the trend is changing that quickly. Okay, so in this case, let's look at 50, stay with 50, simple, close, red, and then we click OK. So what this is what it looks like. Okay, this is what it looks like. And what this is telling us is that when price is above the moving average, that means that price is in an uptrend. What you ought to do then is look for buy trades. Okay, now this instrument itself does not trend very much. There are instruments that trend very much. Instruments like, let's look at AUD/USD. AUD/USD is one instrument that trends a lot. Okay. Hold on, let me check something. Let's check this. Okay. So we have AUD/USD. Okay. So AUD/USD tends to trend heavily a lot of times, right? So we can use AUD/USD. Let's insert a moving average here. Trend moving average. Okay. 50 moving average, so we'll put it here. So, yeah. Now, when we look at this, anytime price is above the moving average, it's telling you to buy. Anytime price is below the moving average, it's telling you to sell. Okay. There are other ways to determine trend, but this is a very simple way, a simplistic way, actually, for determining trends. Okay. Because the market will always buy and sell. The market will always buy and sell. So that's for moving average for trend. Then the next one is the RSI. RSI. So let's insert the RSI. So we'll come to insert again. We'll come to indicators. Now, this is something you can do on your phone as well. It can be done on your phone. This can be done on the laptop. You can also do this on TradingView as well. But TradingView has restrictions because if you use the paid version, I think they will only allow you to put in like 2 or 3 indicators there. Then they will now require you to, upgrade. If you upgrade to a bigger version, a higher version where you pay, then you can access more tools. But if you don't want to do that, of course, I don't. You don't have to use the paid version of TradingView, so you can use the free version of TradingView, or you can use MT4 or MT5. MT5 is free. You can use all these tools on MT5 for free. Are the same tools that you're using on TradingView that you need to pay for. Okay. So let's it's under oscillators. What we're looking for now, we went to trend before. So this is an example of all the indicators are under trends. You have adaptive moving average, average directional moving index, average directional moving index, Wilder, Bollinger Bands, all of them, all of these, right, are usually under trends. Okay. Now, all of them don't show you trend. For all of them, it, it's not all about trends. There are other indicators, volatility indicators, um, momentum indicators are also classified under trend. Yeah, so this is not like, oh, every indicator here is going to show you trend. No, it doesn't. Other types of indicators are classified under trend here. All right. So let's look at ROSI. Like I said, parabolics are not parabolic. So let's come to oscillators. Oscillators, we will find RSI or stochastic. So let's use the RSI. So for the RSI, you can see this now. It's telling us that there's a level 30 and 70. The 30 is the oversold level, while the 70 is the overbought level, like I explained earlier. So which means that if price comes to, okay, hold on, let me just place this here and then, okay. So if you can see my screen, hold on, let me see if I can make this thicker. Let's make this thicker. Okay. Oh, let's make it bluer. Okay, so this is it now. Now, you see there is a range here of 0 to 100. 0 to 100, right? Now, what it means is that when price, so you have 0, you have 30, you have 70. 0, 30, 70. So when what this is telling you is that when price hits 70, that is price at overbought level. Overbought level. So at overbought level, what are we expecting? We're expecting to see price selling. We're expecting to sell trades. So this is an indication that you should be getting ready to look for a sell trade. Then when price hits 30 here, that's an indication that price is about to buy. That is what we call the oversold level. So if price is oversold, just think about it like this. When price is oversold, it should buy. When price is overbought, it should sell. Say that again. When price is oversold, it should buy. When price is overbought, it should sell. So where are you expecting price to buy? Here, this is oversold region. Where are you expecting price to sell? Here, this is overbought region. So the 70 is the overbought region, the 30 is the oversold region. So at overbought, you're expecting a sell. At overbought, you're expecting a sell. At oversold, you're expecting a buy. Okay. Then the next um, indicator here is it's the Bollinger Band. Okay, so we said these Bollinger Bands, the unique thing about it is that it helps see the volatility in the market. If there's a huge amount of volatility in the market, you see it becomes very wide. If there's a small amount of volatility in the market, you see it becomes very, very constricted, constrained. It contracts, sort of, right? So let's see how this is now. This is still, it's not very clear. Let me try and thicken it. So let's widen it. So you can see during certain times of the day, you see that it will widen very heavily. You can see how it widens very heavily. And at some point in the day, it becomes very tiny. Can you see this? Very tiny. It becomes very tiny. It widens here, it becomes tiny here. So whenever it widens, that tells you that there's a huge amount of volatility in the market at that time. Volume is hitting the market. There's a lot of buy or sell volume. So basically, those might be periods around the London session, overlap between London and New York, where so many banks are participating in the market, where the biggest people with the biggest monies are playing in the market, right? Now, during constrained, when these areas where you see constriction, where you see it contract, those are usually Asian session when the volatility in the market is reduced. Market is still moving, but the participants in the market at that time are not very much. The volume in the market is reduced at that time. So this is what this tells you. For most of the time, this is not going to, you're not going to use the Bollinger Band. Okay? You might just decide you want to trade at any time. You don't necessarily need the Bollinger Band. We'll leave it. Okay, let's leave it for now. Then something else we have to look at quickly. How do you use how traders use Bollinger Band? So this is it. Now, confirm trends. Now, when you look at that trend that I showed just now, you see that price is telling you buy at some point, sell at some time point. Now, when you already know how to see other methods, like I said, this is one of the methods that you can look at trends, not the only method. Now, if you have other methods to look at trends, like maybe you understand some other things we'll talk about later, market structure. Market structure can help you understand trend movement very well. Now, if you understand market structure or you are beginning to understand market structure, you can use these indicators to confirm trends. So you won't only be relying on indicators, you'll be using these indicators in conjunction with your understanding of maybe market structure. So put together for you to be able to understand trend. Okay. And remember what I said about confirmation. Very, very important. Your level of confidence rises when one or two indicators in the market are telling you to buy or sell. So it's very important. Then identify reversals, overbought and oversold. So you are able to see that, oh, price is about to buy from here because it has oversold. Price is about to sell from here because it has overbought. Then it helps you spot breakouts as well. Breakouts is what Bollinger Band squeezes. So when price breaks out of a Bollinger Band, that gives you an idea, oh, price is likely to go higher or lower. So the idea here is to combine one, two, or three indicators together to give you an idea of what you should be doing in the market, but not too many of them, right? We've mentioned several of them earlier, but you can see while doing my uh, while analyzing here, I'm only using a few. I'm not using everything. I'm not using ATRO. I'm not using um this ROS. I'm not using stochastic. All those things. You don't need to use all those things because when you use them, then your chart becomes very noisy, right? And then one signal might conflict with another one. At the end of the day, you end up with analysis paralysis. You have a lot of signals or a lot of indicators on your chart. Some are telling you to buy, some are telling you to sell, all at the same time. And then you begin to wonder, which one should I do? Then you become confused. You see trades playing out right before your eyes. Trades you already thought to buy will probably start buying, and then you are wondering why did I miss it? Because you had another thing on your chart that's telling you to sell. See? So it's important to make sure that we're only using a small number of indicators, right? So one strategy that is very important with indicators here is what we call the moving average crossover. This has to do with entries. So take note of this. I said the first thing you're doing when you come to the chart, you're looking for market direction, which is trend. Then the next thing you want to do is what you're looking for entries. Then the next thing you want to do is you're looking for risk management. Now, for entries is what I want to talk about now. Very briefly, we're almost out of time. So we have an indicator here that's telling us to buy, that's telling us the trend, giving us a trend. Then what we can do is that we can add another indicator to this to give us entry. So we have this indicator already telling us when price is above it, we're looking for buy. When price is below it, we're looking for sell. That's what trend is about. Okay. Now, if we add another indicator to it, that can give us an idea of where to enter the market for a buy or sell. So let's add another indicator to this. So we'll come here again, we'll come to insert, we'll go to indicators, we'll go to add another moving average. This time, we'll make it a slow moving a fast moving average. This 50 is a slower moving average, even though those are slower, like 100 or 200. But let's put up a faster moving average here, so that one, whenever that one crosses this red one, it would give us a signal for entries. So let's use a 4. So a popular strategy is a 4 and 50 moving average. 4 and 50. Okay. So simple moving average, 4 and 50. So can you see this now? So you see if you see a 4, the 4 is the green one, sorry, the blue one, the 50 is the red one. So what we are looking for here is this. When the blue one crosses the red one, which means 4 crosses 50 from the downside, that is giving us an idea for a sell. That's giving us an indication to buy. Sorry. When the blue crosses the red from under, crosses it higher, that is a sign to buy. So at the time you see that cross, you can get on a buy trade. So you can see how we're using we are using one candle. Remember, here, this is more like a confirmation. Remember that when price is above the red line, the red moving average, we're already expecting price to go up because that's an uptrend now. So when the when the blue one now crosses again the red one, that is an extra confirmation telling us get on your buy trade. Then when the blue one crosses from above and comes down, that is an indicator to sell. That's an indication to what? Sell. So this is like using your moving average in two different ways right now. So you can decide that you're going to use it for entries, use it to define trend, and also use for entries. So this strategy I just showed you guys briefly right now is very, very effective. And it's quite popular as well, right? Um, so whenever the red one, go over this again, whenever the blue moving average with the slower moving average crosses the red one, which is the fast moving one is the blue one. When it crosses from below, that's an indication for a buy. When it crosses from above, that's an indication for a sell. So I'm going to end our class here today. Do we have any questions? We're out of time actually.